need better breadth of earnings revisions. I mean, this has been a theme of ours for the last 2 years. One of the reasons why we weren't maybe as enthusiastic as others in terms of the rally we've had is because we thought it would be narrow. In fact, our forecast suggested that the earnings recovery itself was driven by heavy cost cutting in the Mag 7. And then, of course, they had AI, which helped a handful of companies. You had a few other themes that were driving growth. You had government support for infrastructure spend, things along those lines. And so it was very narrow. So in order for the market breadth, the price breadth to get better, you need earnings breadth to get better. I don't think it's that complicated. And that's what we think should happen in 2025, assuming, once again, that we don't get some policy changes that are maybe negative for the market in the near term. And that's really our concern in the short term, is that we think some of the policy changes are probably going to be more negative in the beginning and then more positive in the second half.
Hey, Mike, as we all know, the S&P 500 over each of the last 2 years has grown north of 20%. I'm not sure earnings have grown to that extent. What's the valuation call right here as you think about the market here, Mike?
It's expensive. I mean, that's not a great insight. I mean, this is probably the single biggest miss by, I think, everybody in the last 12 months. I don't recall anyone saying they thought we would trade to 23 times earnings, but of course everybody rode the wave, including us, and you're happy to take it. And so now you're sitting here 23 times earnings, and you're like, well, now we need to see the earnings actually surprise to the upside. And you're exactly correct on the fact that earnings have not been the main driver of the returns. The main driver of the returns has been equity valuations.
Right.
And there's been some specific names that have done a great job in earnings, and those are unique. But overall, this has been probably one of the biggest multiple expansions we've ever seen, coming out of a recession.
Okay, so what does that do with cash for Mike Wilson, for Lisa Shallot and Morgan Stanley Wealth Management? Is cash your friend right now?
Well, I think, short duration fixed income in general has been our friend for the last several years. Being underweight, duration, whether that's 2 years or 1 year or cash, they're all doing the same thing for your portfolio, Tom. They're giving you a nice 4 to 5% return with very low risk. And so that's a great place to have some of your money. Once again, not all of your money. We're probably 5 to 7% kind of in that cash rate region, which is 2 years and in. And that's fine. That's a good place to be when you're getting compensated. I mean, just recall 2 years ago, you were getting zero on that cash. Now, that's a bad deal. But today, you're getting actually a pretty positive return. And there's a place in every portfolio for something like that. Just ask Warren Buffett.